Let's talk about growing your money. ETFs and mutual funds are two of the most common ways to invest. But what's the real difference? If you've ever wondered which one is right for you, you're not alone. Many new investors find themselves at this crossroads, unsure which path to take. The good news is, understanding the basics can help you make a smart choice for your financial future. You don't need a finance degree to understand this. In fact, learning the essentials is easier than you might think, and it can make a big difference in your confidence as an investor. Investing is for everyone, including you. No matter your age, background, or experience, you have the power to take control of your financial future and start building wealth. Both ETFs and mutual funds are baskets of investments, helping you diversify and reduce risk. This means your money isn't tied to just one company or industry, but spread out to help protect you from big losses. But they work differently, and knowing how can make you a smarter investor. ETFs trade like stocks throughout the day, while mutual funds are bought or sold only at the end of the trading day. Fees, taxes, and flexibility can also vary. We'll break it down simply, no jargon, just what matters for your money. We'll cover the pros and cons so you can see which option matches your goals and lifestyle. The goal? For you to feel confident choosing what fits your financial journey. Whether you want hands-on control or prefer a more passive approach, there's an option for you. Don't let confusion keep you from investing. Every day you wait is a missed opportunity for your money to grow. Even small steps today can lead to big results over time. By the end, you'll know the difference and be ready to decide which belongs in your portfolio. Let's get started on your journey to smarter investing and a brighter financial future. Imagine a mutual fund as a city bus. There's a set route, a set schedule, and everyone on board is heading in the same direction. You don't need to worry about the details of the journey. You simply hop on, and the bus takes care of the rest, following a predetermined path. This makes mutual funds a popular choice for those who prefer a hands-off approach to investing. When you invest in a mutual fund, you can only buy or sell shares once a day, and that happens after the market closes. The price you get is based on the fund's value at the end of the trading day, so there's no need to watch the market constantly or worry about timing your trades. Now think of an ETF as a yellow taxi. You can hop in or out whenever you want, as long as the market is open. The price of an ETF changes throughout the day, just like a taxi fare can change depending on traffic and demand. This gives you the flexibility to react quickly to market movements and make trades in real time. Despite these differences, both mutual funds and ETFs are designed to help you reach the same destination, a diversified investment portfolio. They both pool money from many investors to buy a wide range of assets, spreading out risk and offering access to markets that might be hard to reach on your own. The main difference between them really comes down to how and when you trade. Mutual funds are more structured and predictable, while ETFs offer more flexibility and control over your buying and selling decisions. Mutual funds are especially great for automatic set-it-and-forget-it investing. You can set up regular contributions, sit back, and let your investments grow over time without having to check in every day. On the other hand, ETFs are perfect for investors who want more flexibility and control. If you like to monitor the market, make quick decisions, or take advantage of price changes throughout the day, ETFs give you that power. Ultimately, it's not just about what you own, but how you own it. The structure you choose can impact your experience, your costs, and your ability to react to the market. So ask yourself, do you value the simplicity and predictability of the bus, or do you prefer the flexibility and control of the taxi? Your answer will help guide you to the investment vehicle that best fits your style and goals. Let's get specific. When comparing mutual funds and ETFs, it's important to understand the key differences that can impact your investment experience and long-term returns. First, let's talk about costs. Mutual funds, especially those that are actively managed, often come with higher fees. These can include management fees, expense ratios, and sometimes even sales commissions or loads. Over time, these costs can really eat into your returns, so it's wise to be cautious and avoid funds with high fees whenever possible. ETFs, on the other hand, are typically designed to track an index, which means they're passively managed. This usually results in much lower fees and expense ratios, making them a cost-effective choice for many investors who want to keep more of their money working for them. Taxes are another big difference. ETFs are generally more tax efficient because of the way they're structured. When you buy or sell shares of an ETF, you're usually not triggering a taxable event for other investors in the fund. With mutual funds, if someone else in the fund sells a large amount, it can create capital gains that are distributed to everyone, even if you didn't sell anything. This can lead to unexpected tax bills at the end of the year. Trading flexibility is also a key point. ETFs trade on the stock exchange throughout the day, just like individual stocks. This means you can buy or sell them at market prices whenever the market is open, giving you more control over the timing and price of your trades. Mutual funds, by contrast, only trade once per day, after the market closes. No matter when you place your order, you'll get the closing price, which can be less predictable if the market is volatile. Minimum investments are another consideration. Many mutual funds require a significant initial investment, sometimes thousands of dollars just to get started. ETFs, however, let you start investing with the price of a single share, and many brokers now offer fractional shares, so you can begin with even less, making them accessible for new or younger investors. The bottom line? ETFs offer flexibility, low costs, and tax efficiency, making them a popular choice for hands-on investors who want control and transparency. Mutual funds, on the other hand, can be a great option for those who prefer a more hands-off, automated approach, even if it means paying a bit more in fees. Consider your goals, preferences, and investment style when choosing between the two. So which fits you? If you like hands-on control, trading during the day, and lower costs, ETFs are your style. Prefer a hands-off automatic approach? Mutual funds make it easy to set up recurring investments. Some mutual funds are actively managed by professionals, which can be reassuring but costs more. Most ETFs are passively managed, tracking an index with low fees. It's about your personality. Do you want to drive or have someone else steer? The best plan is the one you'll stick with. Honesty about your habits is key. There's no best, just what's best for you. Both ETFs and mutual funds help you diversify and grow your money. Don't let indecision stop you from starting. The most important step is to invest. If you want control and low costs, choose ETFs. If you want simplicity and automation, go with mutual funds. You can even use both in your portfolio. The right plan is one you understand and can stick with. You're now equipped to make a smart choice. So, take action. Your future self will thank you. You've got this.